Have you ever thought about what happens if your life insurance could actually pay you back while you're still alive? Yeah, most people think of life insurance as something that only helps after they're gone. But what if it could become one of the smartest moves in your retirement strategy? Imagine building a safety net and a tax-advantaged pool of money, all from the same plan. That's what we're exploring today. And trust me, once you understand how life insurance fits into retirement planning, it might completely change how you see both. Because here's the thing, retirement isn't just about 401ks or registered retirement savings accounts depending on your country. Those tools are great, but they come with limits, taxes, and risks. Life insurance, when used correctly, can be this hidden piece that gives you flexibility, protection, and even growth. And a lot of people have no idea how powerful it can be. So whether you're in your 20s, 30s, 40s, or even close to retirement, this could open up some options you didn't know existed. Before we dive deep, if you want to keep learning simple, clear strategies for money, investing, and financial planning, hit that like button to support the channel and make sure you subscribe so you don't miss any of our upcoming breakdowns. All right, let's get into it. Point number 1, understanding the role of life insurance. So let's start from the top. What exactly is life insurance doing in a retirement plan? On the surface, it's about protection. It replaces income, covers debts, and takes care of loved ones. But under the hood, some types of life insurance can actually grow cash value, meaning part of your premium becomes a sort of savings that earns interest or investment returns. Now, most people stop there and think, oh, that's nice. But think about this, that cash value can be accessed tax-free through policy loans or withdrawals. That means in retirement, you could tap into that money without triggering income tax the way you would with your 401k or IRA distributions. So while everyone's stressing about required minimum distributions and tax brackets, some people quietly use life insurance as a personal, flexible source of retirement income. And that's what makes this such an interesting piece of the puzzle. Point number 2, the types of life insurance that work for this strategy. Now, not all life insurance policies are created equal. Term insurance, the kind that just gives you coverage for a set number of years, doesn't really play into this retirement idea. It's pure protection without cash value. What you're really looking at are permanent policies. That includes, for example, whole life, universal life, and indexed universal life, or IUL. Whole life is the classic one. Steady premiums, guaranteed growth, and a predictable cash value. Universal life adds flexibility. You can adjust your premiums and even the death benefit over time. And indexed universal life, that's where it gets interesting. With an IUL, your cash value can grow based on market performance, like an index such as the S&P 500, but without the risk of losing principal when the market drops. So it kind of rides the upside potential while protecting your downside. Now, it's not magic. You're capped on how much of that growth you can get, but it's still a very attractive way to participate in market gains while keeping that insurance benefit intact. The key idea is this. These policies can grow wealth quietly in the background. And because of the way they're structured, they can often grow tax-deferred and be accessed tax-free later. That's the kind of thing retirement planners get very interested in. Point number 3, the tax advantage. Why it matters. Let's talk about taxes, because this is one of the biggest reasons life insurance gets pulled into retirement planning. When you contribute to a traditional retirement plan, like a 401k in the US, you're deferring taxes, meaning you'll pay them later in retirement. But what if taxes go up by then? That's where life insurance becomes valuable, because the growth inside your policy isn't taxed every year like a brokerage account would be. And when you access it through policy loans or withdrawals, it's generally not taxable income. In other words, it can give you control over when and how you pay taxes, or even help you reduce your taxable income in retirement. That flexibility can make a huge difference when you're trying to keep your Social Security from being taxed, or when you want to stay under certain income thresholds for Medicare premiums. It's not about avoiding taxes, it's about being strategic. Point number 4, using life insurance for income in retirement. Now, here's the part that surprises most people. You can actually use a life insurance policy as a source of income in retirement. Here's how that typically works. Over the years, you fund your policy, so you let that cash value grow. When you hit retirement, instead of just letting it sit there, you start taking out policy loans. Those loans aren't taxable. That you're technically borrowing against your own money, and the insurance company uses your cash value as collateral. Then, when you pass away, your death benefit pays off those loans, and whatever's left goes to your beneficiaries. So you've basically used your life insurance as your own private, tax-free bank during retirement. Of course, it needs to be structured properly. If you take out too much or let the policy lapse, it can cause tax issues. But when managed carefully, it's one of those strategies that can give you flexibility and liquidity when you need it most. Point number 5, the hidden perks: protection, liquidity, and legacy. Beyond the numbers, there are softer benefits that matter too. Let's say you're retired and you've got money in the market. If the market crashes one year, you can pause your withdrawals from your investments and pull from your policy instead. That lets your investments recover and you don't have to sell anything at a loss. That's called sequence of returns protection, and it's huge. Then there's the legacy aspect. Your family still gets the death benefit, even after you've used the cash value. So you're not giving up protection just to get income. You're layering both benefits together. And for people who value liquidity, meaning access to their money, a properly designed life insurance plan can be much easier to tap into than traditional retirement accounts, especially before age 60. It's like a Swiss Army knife for financial planning. Multiple functions in one tool. Point number 6, common misunderstandings. Now let's be real. There are a lot of myths around this topic. You'll hear people say life insurance is a terrible investment. And in some cases, that's true. If the policy is overpriced, underfunded, or sold incorrectly, it can be a problem. But when it's properly designed, meaning it's built for cash value growth and funded strategically, it can outperform some low-yield assets and add balance to a retirement plan. Another misunderstanding is thinking it's only for the rich. Not true. You don't need millions. You just need consistency and a clear goal. And lastly, people think it's too complicated. Sure, it's not as simple as a savings account, but that's why it works the way it does. Complexity isn't bad when it's working for you. Point number 7, when it might not be the right fit. Now, to be fair, that is not for everyone. If you're struggling to pay off high-interest debt or you haven't built an emergency fund yet, this probably shouldn't be your first move. And if you can't commit to funding it consistently for several years, the benefits might not materialize. Life insurance for retirement is a long-term play. It rewards patience, discipline, and structure. But for the right person, it can become an incredible hybrid of protection and retirement income. Point number 8, how it fits into a broader plan. Think of it like this. Life insurance isn't the main course, it's more like a side dish that completes the meal. Your 401k, IRA, or brokerage account might do the heavy lifting, but your life insurance can give you tax flexibility, liquidity, and peace of mind. It's about creating a mix, one that gives you both growth and safety. And that's what real retirement planning is all about. So let's quickly recap. Life insurance isn't just for protection, it can be a smart financial tool. Certain types, like whole life or indexed universal life, build cash value that can grow over time. That growth is generally tax-deferred, and you can access it tax-free later through policy loans. It can add flexibility, protect your investments during market downturns, and still leave a legacy. But it needs to be structured and funded the right way, not rushed or treated like a short-term investment. All right, now I'm curious. Have you ever considered using life insurance as part of your retirement plan? Or maybe you've already looked into it. What's been your biggest question or concern about it? Drop your thoughts in the comments below. I'd love to see how you're thinking about this topic. And if you found this video helpful, make sure to subscribe for more easy-to-understand conversations about money, retirement, and financial planning. Thanks for watching, and I'll see you in the next one.